Hello, welcome everyone. Welcome to chapter 5. We are using Foundation of Financial Management 18 editions by Blockhart and Danielson from McGraw Hill. So today we're going to discuss chapter 5, which is operating financial leverage. So the learning objective of this chapter will be define leverages, explain break-even analysis, describe operating leverage, explain the financial leverage ratio, recall the combined leverage ratio, that take into account the use of both fixed asset and debt, and then recognize the increasing leverage in which the firm increases profit potential, but is also a risk of financial failures. Okay, what is leverage? What is leverage? The use of special force and effect to produce more than normal result in a given course of actions. The emphasis on the employment of fixed cost item to magnify return at high levels of operations. It can produce beneficial result in favorable conditions and can produce highly negative result in unfavorable conditions. The leverage determines the type of operational cost, including plant and equipment. It eliminates labor in productions of inventory. Why? There's a tendency now we are doing an automation in many of the industry. Example, in the car industry. In the car industry, there's a tendency to do labor robotic automation. This been done in many of the Japanese corporations, as well as the Chinese manufacturing sector, from Toyota to BYD. Okay, why? There's an expensive labor. That's the reason why. Less an opportunity to for profit, but reduce the risk exposure. Okay, and then determining the type of financing, either debt financing, substantial profit can cause failure to meet contractual obligation and can result in bankruptcy. This is what I've done in the past many times when I was working with Nomura, as well as working for Morgan Grenfell, as well as for BMO as a senior business system analyst. We analyzed a lot of companies that reissue debt financing. The problem with debt financing is that if it is over your capacity, then and the company face failures in case they cannot service their obligations, such as principal and interest. And then, of course, the second option will be selling equity. This is what I've done many times in the past when I was with Nomura. Doing a lot of IPO. I think we raised about $2 billion of many of capital market equity products, selling it either in New York, London, or Europe. Okay, let's look at the next one, operating leverage. It extends to which the fixed asset and associated fixed costs that are utilized in business. Operational costs that are classified will be fixed, variable, and semi-variable. So there's three of them: fixed, semi-variable, and semi-variable. Okay, what are the table one classification costs here? The fixed one will be like lease, depreciation, executive salary, property taxes. Variable, raw materials, factory labor, and sales commission. The sales commission very often very popular among real estate transactions, especially sales. Okay, in the marketing side, mostly sales commissions. Semi-variable will be like utilities, repair, and maintenance. Okay, all right. Let's look at the break-even charts here. As you see, the break-even point is here. This is 50 unit produced. It's going to be revenue is about 100. Over that break-even point is here, showing up here. Over that will be called profits, okay? Over that will be called profits. What is this? The blue one is profit. The total revenue minus total cost here is here the variable cost. The fixed cost will be a linear horizontal diagram here. Fixed cost at $60, okay? The fixed cost. And that also will be covered in red. So in this particular diagram, you're going to look at your need produce sold. Fixed cost will be 60,000. The price will be $2. Variable cost per unit will be 0.80. Okay. Okay. Let's look at the next one. Break-even analysis. Break-even point is 50,000 per unit, where total cost and total revenue lines intersect. So the unit is 50,000. How are you going to calculate 50 times 80 cents will be 40,000 for the variable cost. Fixed cost will be 60,000. Total cost will be 40 plus 60 is 100,000. In terms of revenue, the variable business because $2, 50,000 times 2. So that is going to be 100,000. The break even will be 0. All right, let's look at the next one. Break even analysis continue. This break even can be calculated by fixed cost divided by contribution margin, or fixed cost divided by price minus variable cost per unit, or equal to fixed cost divided by P minus VC, variable cost. So the logic will be like 60,000. 2 minus 8 divided by 2 minus 8, which is about 60,000, divided by 1.2 will be 50. thousand unit. Okay, guys, this is how you're gonna calculate in terms of BEP, break even point, break even analysis. Okay, let's look at the logic in terms of the cost, volume, cost, profit analysis using a leverage from all here units sold. We have here, we discussed in the previous slide, 50,000, variable cost is 40, fixed cost 60, 100,000 here, total cost, revenue are 100,000 here, your operating income or loss will be 0. Above that will be all profit. From 60,000 you get a profit of 12,000, 80,000 you get a profit 36,000, units sold 100,000 you get a profit 60,000. You just plug in the numbers and you'll be able to calculate those numbers. Okay, all right, let's move on to the next one. The most conservative approach. Some firms choose not to operate at high degrees of operating leverage. More expensive variable costs may be subsidized or automated plant and equipment. For the unleveraged cost may cut into potential profitable firm indicated in figure 5.2. This is the way when you look at the conservative firm. Okay, this is about 30,000 less than 80. So the cost, fixed cost will be 12,000. Is very conservative. Price will be $2. Variable cost will be $1.60. Okay, this is a very conservative firm. So the conservative will be about 30,000 units sold. Variable cost 48,000. Fixed cost 12,000. Total cost 60,000. Total revenue 60,000. This is a conservative firm analysis. Above that, it may be profitable. The risk factors that influence decision on maintaining conservative or leverage position include the economic conditions. Economic conditions, we are always cyclical. Okay, remember during the COVID era, we have a recession because that many activities are able to be done by regular people, average Joe and Jane. That's a lockdown for 2 years. So after the COVID, the economy bounced back. And then competitive position in the industry. Do you want to see yourself whether you are the top, for example, in the area of motorcycle, Harley Davidson will be the leader among the motorcycles that are above 1200 cc. And then the feature position, stability versus market leadership. So you need to understand the market stability or versus market leadership. So far in North America, Tesla is the market leadership, have gained the top market leaders in terms of EV battery car. But the position will be in the world will be BYD, a Chinese car maker. They are the number one in Asia and Europe. And then matching acceptable return with desired level of risk. Okay. And then what are the things in the cash break-even analysis? Deal with cash flow rather than accounting cash flow. You need to make sure cash flow is the king. If you do not have a positive cash flow, the company will easily go bankrupt. Analyze the short-term outlook of the firm. Also, example of exclude non-item cost will be depreciation, credit sales, and credit purchase of materials. Okay? DOL. What is DOL? Degree of operating leverage. The percentage change in operation income as a result of percentage change in units sold. It is computed only over provided range in operation. DOL is the firm break-even point. The higher number will be, example of the logic here, DOL equal to percentage change in operating income divided by percentage change in the unit volume. Okay, these are the example in 5.4, leverage of the firm. 0 unit is 60,000, conservative will be 12,000, 20,000 with 36,000 here. Conservative company will be 40,000. 12,000 is 4,000. It's almost, for here you can see it's 5 times. Here you can see more than 8 times. Okay, almost 9 times actually. Here is 3 times. You see the level here in terms of the unit. Only look at the leverage firm. People that highly leveraged mean a company that has high debt. DOL will be percentage change in operating income divided by percentage change in unit volume. 24,000 divided by 36,000 times 100. So when you get this number, you got 20,000 divided by 20,000 divided by 80,000 times 100. So you got 67% divided by 25%. You got 2.7 for the leverage firm. For a conservative firm, it's the same story. 8,000 divided using the same logic. 8,000 divided 20,000 times 100. Divided by 20,000 divided by 80,000 times 100, 40% by 20% equal 1.6. You see the difference here? The average firm has 2.7 while the conservative have 1.6%. The logic will be Q, calculation with QL, DOL will equal to Q price minus VC divided by Q, price minus VC equal to minus variable cost. So where the quantity is computed price per unit, VC variable cost per unit, FC is fixed cost. For the leverage point will be, you just plug in those numbers when you're gonna get 2.7 here. Okay, this is how you get this, plug in a number. Q quantity, P is price, VC is variable cost, FC is fixed cost. These are the definitions, guys. Remember this: Q, P, VC, FC. Okay, so you just plug in a number, then you get the 2.7. Okay, look at the limitation analysis as well. Assume existence of constant linear functions for revenue and cost as the volume changes may not be constant in real world. Price weakening to capture increased market. Cost overrun when moved beyond optimal size operation. What is price weakening? If your price, you're in the real estate business, a good example, if you price your condominium is too high compared to the market, then it will go down. Nobody will buy it. Okay, the same thing with cars. Cars, if you compare it too high, then nobody will buy it. I remember Indian motorcycle when first came to Canada. You know how much they price it? One motor cheap vintage cost about 35 to 40,000. Nobody buy that. So after that, after 3 or 4 years later or 5 years, they price it lower for about 20,000 to 25,000 for cheap Indian motorcycle. So that is the way to capture increased market shares. Okay, guys, you have to make sure if you are in the competitive industry and you're going to compete with the best of the best. For example, Indian will compete with Harley, Yamaha will compete with Honda. Okay, relationships are not fixed or as assumed. Okay, it will change over time depending on the customer preference. Okay, assumption of the exact linear relationship does not hold well in reality. This is an example of the revenue weaknesses here. In terms of total revenue, you have it here, total revenue here, weaknesses, and the cost is overrun here, the total cost. The valid error just already shows you about the losses, okay? Again, I'll give you an example of the motorcycle industry because I myself is a motorcyclist. So you have a competition between Indian motorcycles, very fierce, and the Japanese market will be like Yamaha, Honda, Kawasaki, okay? And those are the three players in the other export will be Moto Guzzi, Satya, as well as other brand, Aprilia. Okay. Financial leverage reflect amount of debt used in the capital structure of a firm, determine how to finance operations, and determine the performance between two firms that are equal of operating capability. Balance sheet will be where asset equal to liability and net worth. You have an operating leverage here on the asset side, and then you have a financial leverage on the liability side. Okay, so that's the key part on the financial leverage. Examine to financial firm that has 200,000 required to carry assets. For example, total assets 200,000. That is 150,000 times 8%. You got 12% interest leverage. A common stock 50,000. You got 200,000. So you need 200,000. This is the way you do leverage because of the you are quite aggressive in terms of company-wise. But if a conservative firm is the other way around, you only raise 50,000, it's 4,000 interest, and then you raise common stock higher, 150,000, 24,000. But at the plan B, you're gonna give more. You're gonna lose dilution. Your ownership will be diluted. You know why? Because you give more shares to other people. Okay, most people that if you are convinced that your company will go up, in terms of earning per share, you will not likely to use this plan B, but you're going to stick with plan A instead. It depends on what your preference, your risk take, whether you're a risk taker or not. This is an example of the plan A and plan B you have here. You see the EPS is 0.25 is 0.25. Different strategies, different. EBIT is at 0, right? All the way. Okay, guys? This is a good, EBIT is earning before interest taxes. Okay? Here is the company here. EBIT at 0, you got 0.75 here, 0.08 EPS. And here, number 2, you got EBIT at 12,000, you got 1.17. Here, break even EBIT is 16,000, so it was 0.25 and 0.25. All the way when you got a bit higher, you got 1.5, this is 0.7. You got higher here, you got 0.3 and 1.17. So it give you a plan on the EPS. Like the earning per share is very key component in the evaluating of the company. Okay, so EPS plan A will be like this, the red one, and plan B will be the B one. So EBIT will be 0.16 here and 0.25, $16 here, 16,000, and the EPS will be 0.25. That is the BEP point where they met each other. Okay, so in terms of computation, the is percentage in EPS divided percentage in EBIT. EBIT means earning before interest tax. And the quantity can be restated like this, -1. So you're going to plug in plan A, the plan A in terms of leverage, you plug in the numbers, and then you got 1.5. For plan B, conservative, you're going to plug in the numbers, you get only 1.1, okay? Limitation use of financial leverage beyond a certain point that financing is driven to the firm, lender will perceive greater financial risk, and common stockholders may drive the price down. Debt is also beneficial and recommended for firms in industry that offer a degree of stability, are in positive states growth, and operate in favorable economic conditions. When everything is favorable and is in the growth state, people mostly use the what you call it, leverage strategies. Okay, but if it is recessionary and the economy, they use a different strategy. Okay, combining between operating leverage and financial leverage, when we do combine both, okay, it has a unit, it will offset the asset structure of the firm and determine the return of firm operation. Remember, if you give too much equity, those people that can request to have to sit in the board of directors and can be subject to takeover sometimes. So you need to find a good combination between debt and equity mix. Make sure it's in a good equilibrium and receive benefit that are allocated for the stockholder as well as per stock bondholder as well as stockholders in terms of earning per shares. Okay, these are an example of income statement. Sales is 160,000, fixed cost 60,000, variable cost 64. You got operating income 36,000. Before interest tax is 36,000 minus interest 12,000. You got earning before tax 24,000, tax 50%. You got 12,000 earning after tax. Yes, is 80,000, 1.5. This is called from here EBITDA or to all the way to shares. We call it financial leverage. Here from sales to what you call it operating income is called operating leverage. Okay, guys. So the last item under operating income become initial item for determining leverage. Operating income or EBITDA are the same, which is representing return to owners before interest taxes paid. Okay, operating income is equal to EBITDA. The name is different. Okay, so this is how the logic of the graphic in terms of the sales, operating EBITDA and EPS here. Financial leverage here, operating leverage here at the lower side. This is 160,000, operating income 36,000. Operating EBITDA is the same, and then we'll take our leverage. Here's the financial leverage you can do. Then you can see EPS is $1.50. Okay, this is again show you in terms of operating financial leverage in terms of sales 80,000 units, 100,000 units. The earning per share will be $1.50 for 80,000 units. And for 100,000 units, the earning per share will be $3. Okay, so in terms of the degree of combination of financial leverage, use the entire income statement, show the impact of the change in sales and volume and bottom line earning. You're going to use DCL, percentage in PS, and percent volume. You plug in the numbers, you're going to get 4 here. Okay, you're going to get 4. You guys plug in the number DCL equal to percent of change in EPS divided by percent change in sales. Okay, so you're gonna go back again, look at the same logic. You can create logic here. You use the same table, put all the quantities 80,000. You're gonna plug in the numbers. You're gonna get 4 here. So this gives you the detail of where is the numbers coming from. Q for quantity, P for price. $2, variable is 80 cents, fixed cost is 60,000, interest will be 12,000. You plug in those numbers using that formula, and then you're gonna get 4. Again, a risk is piled in terms of quotient. Risk is piled onto 2 different forms. Leverage are combined. Firm carrying heavy operating leverage may risk to more position financially and vice versa. The leverage will have a major impact on firm operation. If firm has high debt, it's going to create a problem later on if you cannot service that debt. Okay, you're going to have to restructure and file bankruptcy. Okay, so this is basically the end of the chapter. Okay, guys. So that's basically what we do. The key is to find a balance. The best manager is to find a balance between the use of debt financing and equity financing and strike that formula. Okay, we have seen many companies have done highly leveraged kind of strategy that creates a problem later on. Okay, and we have seen a number of companies that has go bankrupt. Okay, and the next year we'll give you an example, a few of those companies that have went bankrupt because of highly leveraged position. Thank you, everyone. So hopefully you enjoy chapter 5. Bye-bye.